Erik Weir is back with us. He's the founder of WCM Global Wealth, and he's the author of the book, Who's Eating Your Pie? Essential Financial Advice That Will Transform Your Life. Erik, I trust you can hear me this time, so let's get to it. The Fed has been pedaled to the metal again today. Crisp and clear, good. Was this the right choice to do this again?
Absolutely. With inflation the way it's been at 8%, if you look at the last 50 years, inflation's averaged around 3.5%. So the Fed has to be aggressive. And because they're being aggressive, it's actually very good for us. You're looking at long-term interest rates, looking at a 30-year Treasury, are around 3%. So the short-term rates are higher than long-term rates. So that's indicating that inflation is going to be tamed, and we're going to come out the other side.
Okay, let's talk real life, because no offense, but most Americans probably can't pick Jay Powell out of a lineup, but they know their own life. Right. Does this make us more recession likely? Will people be losing their jobs?
We are more recession likely. So what happens when you're increasing interest rates? You're effectively making the things that we consume and what we use our money for more expensive. Housing starts were 1.7 million this time last year. Now they're 1.5 million. It's taking longer to sell automobiles. We've had inflation pressure. So we are definitely feeling it. Americans across the country, we're feeling it in our pocketbook. It's hurting, and it's a concern. And we'll have a period of slowdown where we have negative growth in the process of trying to arrest our inflation.
How about layoffs?
Layoffs will likely happen. You've had unemployment as low as 3%. Now it's still around 4.5%. It's very, very low. So I would imagine you'll see layoffs. You're already seeing large tech companies either slow hiring. Others have actually announced some layoffs. So as we have wage pressures, as you have cost of inputs change, then companies look everywhere they can to cut costs. So I do think we'll see some more layoffs.
If I'm thinking, okay, in the next year, I know I need to buy a car or I need to buy a house, what are interest rates going to be looking like? Because I've read all sorts of predictions. Some people say, well, interest rates could be going down on houses. What are we looking at?
So the interest rates on the long term aren't really set by the Fed. What the Fed does is they're setting the short-term rates, which you're seeing the long-term treasuries around 3%, on homes at 6%, almost double what it was before. We do expect that rates may go a little bit higher, but ultimately I believe that they're going to come back down. So if you're buying a house and you're looking at for a place to live for the long term, now's probably a fine time to buy. If you're trying to time everything, what you're seeing is the listings are lasting longer, less cycles longer now. So if people become anxious to sell or move with a job transfer, I suspect they'll be cutting the prices. So you might be able to get a better deal in the very near future.
And finally, real quick here, should people put off their retirement? You advise people all the time, and I know you can't give specific advice to each person, but should they pause retirement? 401ks aren't looking so hot right now.
Well, that comes back to an individual decision. If you think over the last 30 years, the markets have gone from around 2,000 as defined by the Dow Jones Industrial Average to 30,000. So with perspective and timing, things go great. It's very difficult to predict what's immediately ahead of you. But if I'm looking at things slowing down and I'm looking at retirement, then I want to have a little buffer that I may not have thought about maybe as recently as a year ago.
Okay, some good advice and a little snapshot of what we're looking at in the future. Erik Weir, WCM Global Wealth, thank you. Appreciate it.